Hey guys, so in the last video I spoke a little bit about money and the role it serves in our modern societies and what it is and how it's a commodity and how the supply and demand of money can change over time and how looking at money differently can affect the way you analyze your own investments. So in that video, one of the things I suggested to open up or change the perspective on what money is and how you can use it to value assets was you could look at something like the US house prices to gold ratio. In that, if you look at house prices in terms of gold, an ounce of gold, then you'll see that throughout history the relationship's quite stable and the prices are not perpetually going up, rather are tracking a sort of a line, in that what that represents is, or tries to represent, is that, if the supply of money is increasing, then all goods and services go up in price, including asset prices like houses. So if you were to use another good like gold, which is a commodity, to value house prices, you see a much more stable relationship. And that allows you to back out the inflation or depreciation of a currency from your investment analysis. But when I said that, I didn't want to imply to people that you're only looking to pay a certain price for an asset that's below. So in the US house price case, like, you see that house prices tend to revert back to 100 or 150 ounces of gold throughout history, and that there are periods where they get elevated into bubbles and they come back down. But I didn't mean to imply that you'd only buy a house if it's less than 150 ounces of gold. I mean, that's price, and when it comes to assets, you're looking at value. So a house has cash flow, whereas something like gold, which you could consider a commodity or another form of currency or money, doesn't have cash flow. So, and whilst it might not depreciate over time, when you're making an investment, you're thinking about the future cash flows of that investment as well. So you got to think about things in total value. I'm not saying go put all your money in gold and just park it there for life and accrue as much gold as you can. I think there are better ways to make return than just buying some gold. I mean, that said, I have invested a little bit in gold and a little bit in silver, but they wouldn't make up the majority of my portfolio. So I wanted to give a bit more of a bigger picture to the story and sort of explain that these sorts of price deviations and using something like gold as a metric to value your assets can work in any country, and you'll see these relationships are fairly consistent around the world. Now, that might seem incredible or revolutionary to a lot of people who haven't thought about money and finance in this way before, but as you come to understand markets and the psychology of markets and energy and return on investments and cash flow from investments, you start to understand why markets move like this, and that the fundamentals that work in one country apply to other countries, and you can start to become an unconstrained investor that can think a little bit more laterally about your investments and not potentially be an investor that's just looking to jump on the bandwagon of what everyone else is talking about. In that, if you want to become a superior investor or the sort of investor that can beat the market regularly, you have to be able to see the forest for the trees, and you have to be able to differentiate what is a good investment and cut through the noise, because there's a lot of noise out there, as I've spoken about in another video. There's always someone selling something, and they're selling an agenda, and they want you to believe certain things. And so you just want to be able to, I want to be able to give you different tools to analyze markets and pricing differently. And hopefully over time, there's obviously a lot to this story. There's a lot that makes up markets and financial markets. So it's nothing I can explain in one video. So please do subscribe and get engaged in these videos, and I hope to be able to show you what I've learned over the last 20 years of investing. And maybe the most important thing I'd like to show you is that, how money moves around a lot, all through markets, between markets, whether that's bonds, stocks, gold, commodities, property. Money moves, and it tends to move in trends, and you can really start to predict markets once you understand how markets work. And to be clear, when I say predict markets, I'm not talking about predicting markets with precision. So timing's one thing, but understanding financial laws and the gravity of how finance works, and the physics of our systems, and how natural laws apply to financial markets as well, is something that I'd like to show you over time. And I say you can't predict it with precision in terms of timing, because prices of assets and psychology towards markets can deviate from trends for very long periods of time, sometimes years, sometimes decades. But in the long run, things tend to revert back to the mean, and prices tend to make more rational sense and reflect future cash flows in the long run. And there's many reasons why these distortions occur in markets, and they can be due to new energy sources being found, or changing population, or increasing productivity, or new markets opening up, maybe new emerging markets, China or in India. All these things can have a very big impact on finance and how money and goods and services move around the economy, and can change the way people perceive an asset. And sometimes people believe that what's happened the recent past, last 5-10 years, will be sustained into the future, which isn't always the case. It's just they're temporary blips in the market that create positive feedback loops that allow prices to get elevated beyond what is rational. And at the end of the day, you're always trying to remember that price is what you pay and value is what you get. So value being, the total returns of that asset over time, whether that's the cash flows that will come from that asset or that investment, which I've spoken about in a previous video, and trying to cut through the noise of what money is, and things like inflation and interest rates and money supply, and all those things can help. And you can use tools like this, like using gold or something to value something, in contrast to history, will help you improve your returns on investment, hopefully. All right, well, I hope that was a little bit insightful, and I will see you guys in the next video. Remember, comment if you have any questions, subscribe if you want to see more of these videos, and share it if you want to help your friends and family. See you guys in the next video.